Our next guest is general partner at the Founders Fund, which invested early in Facebook, Palantir, Airbnb, Spotify, Lyft, and others. He's also the founder of Open Door, with a background also at PayPal. Keith Rabois joins us now, along with our own Leslie Picker. Leslie, welcome, and I'll let you kick it off.
Tyler, thank you so much. And Keith, really excited to have you here because, as Tyler mentioned, it's been a very big year for you, especially as it pertains to public listings. You've got Open Door via a SPAC, Palantir via direct listing, expected next week, DoorDash, which is reportedly seeking the traditional method of going public. Airbnb's process still a bit up in the air at this point. I'm sure you're aware of the debate amongst your peers in Silicon Valley about the drawbacks of various methods, the benefits of various methods. Which camp do you fall in?
Well, I don't believe that there's a one-size-fits-all solution for all companies. All startups are different. Some companies need capital as part of the process of going public. Some companies have a premium on speed. Some companies care about the pricing versus shareholder base. So there's a different solution that may be more appropriate for each company. So I think each company, that's why I believe I'll be involved in maybe somewhere between 4 and 6 companies, in the public markets sooner rather than later. And I think each company is going to choose its own path.
You may have seen yesterday, SEC Chairman Jay Clayton spoke on Squawk Box, where he said that the regulator is going to be taking a closer look at SPACs. They're going to look particularly at compensation for the SPAC manager as well as disclosure. What do you make of this whole SPAC frenzy that we've seen this year? And are you concerned that this party could end badly next year?
No, I don't believe so. I think it's wise to have transparency in compensation and transparency to sponsors. The SPACs I've been involved in and the ones I've contemplated, I believe the compensation to the sponsor is comparable or better than sort of the IPO premium that bankers usually extract. So I think some of this is driven by bankers not liking competition. Banking fees have been sort of a pseudo-monopoly for decades. But I welcome more and more visibility. Shareholders should understand the complete transaction and the compensation to everybody involved.
It's no secret that big tech has caught the ire of Washington, both in terms of content as well as competition. Do you believe that this scrutiny is warranted?
Well, I believe there's different concerns that different parts of the political spectrum have. So on the conservative side, people are concerned that there's a kind of a monoculture in Silicon Valley, a very left-wing monoculture. You just look at the contributions to various candidates, you can see a 99% skew. And there's concern that content views that are more of a conservative perspective are being suppressed. On the left, you hear these big is bad kind of arguments, and they try to use the vocabulary of an antitrust argument, which doesn't make much sense. As a former antitrust litigator, these are fairly irrational arguments. The monopoly market share of almost all of these companies just isn't there. Google, maybe you can create a traditional antitrust case, but the idea that Apple, Amazon, Facebook pose a monopoly is just ridiculous on its face.
And you had so many fascinating thoughts that you shared in your own presentation on how remote working won't work for a lot of companies and how COVID has forced a lot of discipline in Silicon Valley. But on China, you're very hawkish. You call it a serious geopolitical threat to the U.S. And at a time when a lot of the TikTok debate is kind of being met with this eye roll and, look at how messy this deal is and why are we talking about a goofy social media app? I mean, why do you think it's important that the U.S. has a strong backbone, if you think it is, when it comes to TikTok? And where is this kind of face-off with China leading?
Well, I believe we're facing a serious confrontation with China, basically a Cold War. China has global ambitions that are inconsistent with the United States democracy. China is an authoritarian regime committing genocide. China wants to expand its influence and feels threatened by the United States, capitalistic free market, free information, free flow. And this is an inevitable tension. And the United States has basically deferred confronting this problem for 30, 40, 50 years. And finally, somebody's paying attention, which is great. But we've basically been asleep at the switch. So China's been investing in technology, under the hood, infrastructure. Now they're investing, competing on the front end. They've been stealing IP for decades. There's no doubt that somebody's going to have to, whether it's this president or the next president, somebody's going to have to eventually solve this problem. We have a supply chain where we can't manufacture cell phones, but drugs, prescription drugs, PPE to protect people in the United States, we have a serious strategic deficit vis-a-vis China. They've been building a Navy. One has to ask the question why they're building a Navy. Navies are usually designed to export power, not designed to protect. So fundamentally, this is a real world problem. China in some ways may pose a bigger threat than the Soviet Union ever did because they have a better economic engine underneath the hood. The Soviet Union had an artificial economic engine with a lot of very smart scientists, and they propped it up for half a century. China has a real economic engine, real innovation, real engineering talent, real AI talent. This is a world-class problem for the political world.